George Soros has been in the news recently, particularly through his political involvement. Actually, it's his son now that is running the show, but still, he's definitely the éminence grise behind all the machinations of his son. Now, this is not a political episode here. Actually, I want to talk about Soros as an investor because, let me be clear, I don't like his political involvement at all right now, particularly what he's doing in the US and in Europe. He's instigating a migration crisis. He's, in my opinion, destroying the inner cities of the US by funding district attorneys that are very soft on crime, way too soft on crime, which has the unfortunate effect that crime is growing and homelessness and drug related problems and all that stuff. So, but here's the big but. As an investor, Soros is somebody you can learn from. And the purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. So I think it would be a disservice to our listeners if we just ignored him because of his political machinations. As an investor, he's great. And I also want to bring in Stan Druckenmiller, who is one of the people that worked with him. I don't know if I can say he was one of his disciples, because Soros is not the kind of guy who has disciples. He's not the person that fosters others, develops others, and things along those lines. He's a one-man show. So disciple would be maybe a little too much. But what he definitely is somebody you can learn from, and that's the purpose of this episode. Now, there's three things I want to talk about. One is, what is global macro investing actually? Okay. Then second, Soros is the master of it. And the reason he's the master of it is because he understands leverage, which is, so for people actually who've trained JiuJitsu, you might actually understand what I'm talking about. And this is the connection here, that you want to use a force that is already happening. So you want to use let's say in physics terms, a vector that is showing in a certain direction, and you want to amplify that vector with your investment, or in jiu-jitsu with your action, and that's how you make money. That's what global macro really is about from a strategy perspective. And third, what I want to talk about is actually how this can be used in other areas, in particular in let's say the type of investments that we are doing, which is investing in fundamentally new concepts and engineering practices. This is not even on podcast. It's January 7, 2025. This is Krim Delco. For the year, we're up 4%. The market's at 1%. We're outperforming by 3%. Just before I go into the conversation, there is some headline news this morning in Reuters. I'm in Europe, so I'm a bit ahead of the markets, that there's a NHTSA investigation into the actually smart summon about Tesla. The stock's down about 1.5% pre-market. It's very, very early, so it doesn't mean much in terms of price action. I just want to discuss what that means and how we feel about this. So NHTSA is in many ways actually doing their job, right? We have new technologies, we have new behaviors, we have new all kinds of things going on with transportation, a lot of them driven by Tesla, some of them driven by other companies. We've seen the similar attacks against, let's say, Uber and Lyft. So when things change at that magnitude in markets that are as big as, let's say, transportation, you will have regulators pushing back. Whether they're pushing back because of their own genuine concern, or whether they're pushing back because they're being paid by others or nudged by others, such as short sellers or competitors. That remains to be open, but you will have pushbacks by that, and this is just the way the process works. Now, part of the reason Elon Musk is getting involved in U.S. politics is because of the fourth branch of government, because of exactly these types of situations where regulators take, not the law in their own hands. That's a little too much, but they can really make your life very difficult. Kamala Harris, there's a famous video with her saying something along the lines of, listen, I can indict you, and even though you're not guilty and you will be acquitted, I can ruin your life just as a DA, right? And this applies to anybody who has power. And unfortunately, even in the free world, even in the so-called free world that we live in, which is certainly freer than many other worlds, but still, even here, we have that same type of uh, you know, persona. Julian Barnes in the Noise of Time calls it the power. He's referring to Stalin and people like that. But we're not in the Gulag area here in the U.S. But again, there is a persona called power, and that power can have repercussions. And this is what we're feeling right now with Tesla. We've been feeling this all the time as investors. So we're going to have to go through this. Actually, Smart Summon is the first step towards what we call self-supervised native products that Tesla can offer, which is the car actually drives itself without anybody. You will have crashes, you will have problems, you need to iterate like every other technology. This is nothing new, nothing unusual. Tesla's doing an amazing job proliferating self-driving in the context of all these pushbacks that they are getting. Particularly at the price, right? You could say that Waymo is doing a good job too, but the price that Waymo is paying in terms of dollars is just immense, and it's not scalable what they're doing. So what Tesla is trying to do is build a self-driving technology that is sustainable in an economic way, and it's just you're gonna have crashes, you're gonna have mistakes happening. I mean, we're using FSD all the time. We're at FSD 12 point something, so we're not in the 13 range yet because we have hardware 3. But the point is, like, the car's making mistakes, particularly, for example, the cameras are not able to deal with extreme sun exposure, things like that. So there is always we still need iteration. We need to work on the same way every other technology in the world needs to be developed, particularly newer technologies. And we're invested in disruptive technologies, which is what new engineering practices really are. And therefore, they're still in the development phase. So you will have these types of situations. The stock is fairly valued. Maybe there's some 20-30% upside from here in terms of just valuation perspective. So what I'm trying to say is that we have vulnerabilities. We'll have corrections when these types of news happen. And this is what we're seeing today. We've seen yesterday already. As investors, we've been in the stock for over a decade, and we have a very clear North Star, which actually got reiterated yesterday, which is the second thing I want to mention, just market-wise. Jensen gave his keynote at CES, and just to summarize that he is betting the company, betting the farm on real-world AI, on robotics, on humanoid robots, and Tesla obviously is in the thick of that market. And for what you need for that is, on the one hand, training infrastructure, and on the other hand, you need applications. And Tesla has both. Now, let's talk about George Soros. So we're switching now to the actual topic of this episode. George Soros, greatest macro investor probably of all time. And I think we can learn from him. We can learn from him. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. So let's learn. Let's learn what George Soros has done. Now, what is global macro? First, let's talk about what is global macro. Global macro in the sort of Wall Street sense, if you meet a hedge fund that says, yeah, I'm in the global macro space, you will have to think about, let's say, somebody who buys currencies, shorts commodities, maybe buys indices. So what macro really means is we're looking at the big picture. We're not going to deal with the 10K of a company or the relative market share of a company. Those are not the kinds of things that we're dealing with. We're not dealing with, let's say, distressed debt or valuations of companies individually. That's not where we make the money. We're not forensic accountants. What we're looking at as global macro traders is, or somebody like Soros would say, the British pound is overvalued. There's something going on, or the Brazilian real is overvalued, or there's the Lebanese pound. So a lot of currency stuff, commodities. You can see people, particularly Druckenmiller. He was involved in equities actually as a global macro trader. That means that you could have a view, let's say, if you think that for some reason from a macroeconomic perspective, copper prices will rise, you can then buy equities that will have leverage with copper, and then they go up because copper prices go up. So Druckenmiller actually, he does something very interesting, which is he looks at companies. So he does his research by talking to companies, and then he has global macro views based on that research. So the idea there is that, look, I mean, when you want to understand what's going on in the big aggregate, you can do it two ways. You can do it top down. So you can basically talk to the Fed or to presidents and people like that, maybe other large macro investors. You can follow the money flows, right? Where's the money going? And then make your call. Or you can go bottom up, which is, look, how do we understand what's going to happen in the aggregate? Kind of a little bit like physics, right? You do particle physics, you try to understand the individual particles, how they behave, and then from there you infer how the whole aggregate will behave, like condensed matter physics, for example, does that, particle physics in general. So you look at the individual components. So back to in the investment world, the individual components, the unit of analysis could be a company, it could be a sector, a bank or something like that. And then you extrapolate, you sort of aggregate all this information up into a global macro view. So that's generally what global macro is. Now, this was just a description. This is, Finance 101, not very interesting. I think what's really interesting is much more, how did Soros make money? And the short answer is what he did is he leveraged events that were going to happen anyway. So events that want to happen, and then he just leverages them either by investing, sometimes just leaning onto them. What do I mean with events that want to happen? Well, there's some organic stuff that's going on in the world. Like things happen. Let's say the weather happens, waves happen when we surf. Nobody's making those waves, right? At least nobody, like human type nobody. I mean, God might be making them, but that's a different conversation, right? So nobody, like we don't have to pay somebody to make those waves. Why is Bitcoin successful? There's no throat to choke. This is just happening. People voluntarily are buying Bitcoin because they want to protect themselves against inflation. So these events happen. They happen anyway. Now, what Soros is doing, first as an investor, and I want to talk a little bit about his political activities, which are very similar, by the way. But in politics, in investing, the most famous trade he did was the shorting the British pound. Now, what was happening there was that Germany just unified, and the Germans, they had their Deutschmark. They just unified with East Germany, and because the Germans were obsessed with inflation, they kept interest rates very high because they wanted to prevent inflation. And the reason there was a risk of inflation was because when you combine a weak economy with a strong economy, there is this general fear that you could have money printing or loose government spending just to prop up this new attached body called East Germany. So because of that, the Germans, they didn't want that to happen. So the first idea in this trade, which came from Druckenmiller, was that the Germans are obsessed with inflation. They're not going to let it happen. So they raised interest rates. The second piece of the analysis is that the Brits are tied to the German mark, to the European economy, and through the financial flows of the European economy in the early 1990s, and therefore their interest rates and their currency are tied to the German mark. Now, there's two ways an economy like Britain can deal with such a dependency: through currency or through interest rates. In other words, they can either keep their interest rates similar to the Deutsch mark, and therefore keep the currency stable. So in other words, have also very high interest rates, like Germany had, and then keep the pound tied to the Deutsch mark. Or they can have their own interest rate policy, but then most likely the currency will behave not like the Deutsch mark. It might go up, it might go down. Now, in this case, this is the third part of the analysis. What Druckenmiller analyzed was that he said that most likely the Brits will choose to have their own interest rate policy because they can't afford high interest rates. Their economy was weak. And if they choose to have lower interest rates, then the pound will have to go down. Now, on top of that, the fourth part of the analysis was that there was a peg to the Deutschmark. I don't know if it was a hard peg or a soft peg, but the pound was sort of trading in a very narrow band that was matched by the Bank of England. So the downside of shorting the pound against the Deutschmark was almost nothing, because there was a peg, right? There was a peg anyway. So even if for some reason the pound would have rallied against the Deutschmark, they would have not let that happen in the first place. But most importantly, the vectors, the forces, the macro forces were all showing into the other direction, which is down. And what Soros did is he amplified that by shorting the pound, basically, buying, borrowing Deutschmarks and shorting the pound, or the actual mechanics of the trade are actually different. Excuse me. You have U.S. dollars, and you borrow, you short pounds, and with that money you buy Deutschmarks. So you go short the pound and long the Deutschmark, and that he did that at a very, very high clip. In other words, billions and millions of dollars, and then the whole thing collapsed, and he made a couple of $1 billion with that trade. So this is just the ultimate trade that everybody learns now in Finance 101. I chose this just to illustrate that what Soros did was really what every global macro is striving to do, which is it's a low-risk trade. You can have very, very high position, 6-7 times leverage on a position like that, and therefore make a lot of money on your equity. Now, final thing I want to talk about is now, how can this be, just a few words on the political strategy, because what's so interesting is there was a tweet today about from Elon Musk about Soros, and he said he's really a great arbitrageur, like not just in finance, but also in politics. He's able to put very little money into events that then happen and amplify them. And the reason he's very good at that is because he does the same thing in politics. He amplifies things that are happening anyway. For example, the migration crisis in Europe. Like, the migrants are coming anyway. They don't need George Soros to come. So what he does is he just puts a little bit of money in certain areas. Of course, you have to be smart to put them at the right areas, but nevertheless, it's not very hard to amplify a movement that is already, that wants to happen already by itself. For example, financing NGOs that bring in, that help migrants come from Africa to Europe, or in the case of the drug trade in the US, financing DAs that enable, drugs being sold on the streets of inner city America. That's going to happen anyway. So if you make it a little bit easier, then you could have an amplifying effect and destroy the inner cities. Why he's doing that, by the way, I don't know. One theory is that he's short commercial real estate or residential real estate in big cities. That's possible. I don't know why he's doing that, but that's, again, a good example of what people call arbitrage. In my opinion, it's not necessarily arbitrage. I call it financial JiuJitsu, which is the ultimate idea of JiuJitsu is to lean on something. Let's say your opponent wants to push you in a certain direction, and then you take that power, that force of the opponent, and let's say you go out of your way and then have him sort of fall through, and then you take his back and choke him or something like that. So typical like jiu-jitsu / judo type move where you use the opponent's strength as leverage for your own strategy. So that's what he's doing. Now, as a final thing, I just want to talk a little bit about, okay, what does this mean for us now? We at Orange Capital Partners, we did start actually as global macro investors ourselves. We then changed our strategy after 2008. It became a little bit difficult to do that. The Fed started QE, and it just became very convoluted in terms of what actually global macro even then meant in a time when you literally had central planning actually through the Federal Reserve. So that's why we went to the other side, which is technology and disruption. And I think that was a good idea because most of the wealth creation actually happened there. So my point here is that you can do the same thing in many other areas. For example, in technology, what you want to do is things that happen anyway, and then you amplify them maybe with a little bit of research and development, maybe a little bit of a nudge. One nice example of a nudge would be something that actually Elon Musk did together with Peter Thiel when they had PayPal, and that was that they paid people to adopt PayPal. Now, that in itself might sound like a stupid strategy, but what they did was the same thing. There was a natural tendency to use PayPal by a very specific customer base, which was eBay. eBay was the kind of place that is still today, where people traded stuff online. And back then, paying for these things was very difficult. You had to send literally checks by mail, things like that. It was just a nightmare. So having an email-based payment system, which PayPal was just a natural thing that people wanted anyway. So all PayPal had to do is bring in enough people, build a network effect, and then of course deal with fraud, and then make it happen. It happened anyway, and PayPal was a success, and eBay was a success. So that's kind of a canonical example of technology. If we take self-driving cars today, the Cybercab, look, people want to have 10 times more value at 10 times less prices anyway. Like, they want this. You don't have to convince people to sit into a Cybercab and enjoy a ride for 5x less than an Uber, and have watch a movie and enjoy while you're driving in a really cool looking car versus the Uber experience or some other type of ride experience, ride hailing or traditional taxi experience. So people want that anyway. Now, when it comes to tech investing, sometimes you have to ask yourself, let's say, there's technology risk, there's science risk. And the way we think about this is when the Venn diagram of science, technology, and entrepreneurship come together, and you have a market, a natural demand, that's where you want to put the money. So to summarize, I think what we can learn from George Soros is that as an investor, you want to sort of be like water, right? You want to slip through fingers and hold up a ship. In other words, you want to be flexible and flow with gravity. And then when you actually have something that is flowing the right way and it fits your strategy and maybe also your ethical and moral standards, you just put a lot of money on the line, and then hopefully you go with that force, and the force makes money. In other words, you use the leverage for your advantage. You do something that would happen anyway, and you amplify it, or sometimes just lean on it, or both. And that's how global macro investing works. In our opinion, that's how any kind of wealth creating investment strategy works. Thank you.